Hi everybody, this is lecture, this is ACT3110 week 11, lecture 2. We are still in topic 6. In the previous lecture, the first thing that you have learned is about management accounting. So I have told you that starting from topic 6, you will learn about management accounting. I think in the among the first thing that you have learned in this topic is the difference between management accounting and financial accounting. So always remember, uh, the first difference is the output of financial accounting is the financial statement, but the output of management accounting budgets and cost report. In accounting, most of the time you will learn about how to calculate costs and also how to prepare budget. And then you have to know that the main user of financial accounting is the external user, but the main user of management accounting is internal user. Another one, when you do financial accounting, you have to follow accounting standard. Every company has to follow the accounting standard. So every company will use the same way of recording and preparing the financial statement. But for management accounting, there is no standard. Every business has its own way in doing the management accounting works. Maybe they have different format of budget, slightly different format for budget and cost calculation or etc. Okay, so the next thing is you have learned about cost, and you have learned about several categories of cost. I think the first category that you have learned is manufacturing cost. So if there is a question asked you what are the manufacturing costs, so the answer is in management accounting, manufacturing costs are direct material costs plus direct labor costs and plus overhead costs. It means that if you have a business and your business manufactures something, the cost to manufacture that product is equal to direct material cost plus direct labor cost plus overhead cost. And then from that you have learned about, I think, another category is non-manufacturing costs. So if there is a question asks you what are the non-manufacturing costs, the answer is admin costs and selling costs. And then you learn about the prime cost and conversion cost. So this one you have to memorize. If a question asks you what is the prime cost, so the answer is prime cost is equal to direct material cost plus direct labor cost. And if a question asks you what is the conversion cost, so the answer is direct labor cost plus overhead, manufacturing overhead cost. And then you have learned about product cost and period cost. So remember this, product cost equal to direct material plus direct labor cost plus overhead cost. That is product cost. Product cost is the cost that you have to pay, a cost that a business has to pay to produce something. That is product cost. Period cost equal to admin cost plus selling cost. We call this as period cost because most of the time a business has to pay this cost periodically. Product costs are costs that a business has to pay every time a business produce one product. So every time a business produce a product or one product, the business has to pay that cost. So that costs are direct material cost plus direct labor cost plus overhead cost. Okay, that is I think the thing that you have learned last in the previous lecture. So in this lecture you will learn about several categories of cost, other categories of cost. So let's see the first one. This one, understand the difference between variable cost and fixed cost also. Okay, so cost also can be categorized into two categories. Some costs are fixed costs, some costs are variable costs. Okay, if you know, if you can categorize costs into variable components and fixed component, then you can use that knowledge to make cost prediction. Okay. So, what is a variable cost? So the answer is very simple. There are many costs. Some of them are variable, some of them are fixed. So what are variable costs? Variable costs are costs that will change when quantity of production or activity of production changes. Fixed costs are costs that will not change even though quantity of production or activity of production changes. So in the next slide you will see examples. Okay, this is an example of variable cost. So remember, I have told you variable cost is a cost that will change when activity of production or quantity of production is changing. So this is an example. In this slide, you can see the everyday life example. The total texting bill or SMS cost, your total texting bill or your total SMS cost is based on how many SMS you send. You know, you have handphone, you can send SMS. We are not doing that now. Not much of that now. Because now we have WhatsApp. It is free, isn't it? So many years ago, there is no WhatsApp. Most people use SMS to communicate. The typical charge is like this. One SMS is 10 cents. So you send one SMS, it is 10 cents. 2 SMS, 20 cents. 3 SMS or text, 30 cents. So something like that. So that is an example of variable cost. The more you use the SMS service, the more you have to pay. So that is the everyday life example. But if you have a business, if you have a manufacturing business, an example of a variable cost is the direct material cost. Let's say you have a business that produce soft drink. So let's say one bottle of soft drink, the direct material cost is $1.50. So direct material is an example of a variable cost. One bottle, the direct material cost is $1.50. 2 bottles, $3. 3 bottles, $4.50. 4 bottles, $6. So that is an example of variable cost. The cost that will change when the quantity of production or activity of production changing or changes. Okay, always remember that direct material cost is a variable cost. Another typical variable cost is in a manufacturing business, direct labor cost is also a variable cost. Direct labor cost is also a variable cost. So the thing is like this. Maybe to produce one product requires 2 labor hours. Let's say, for example, 2 labor hours. One labor hour, the rate is $8. So one product, $16 direct labor cost. 2 products, $32 direct labor cost. 3 products, $48 direct labor cost. So that is an example of a variable cost. The higher the quantity of production, the higher the cost. The lower the quantity of production, the lower the cost. That is the nature of a variable cost. So this graph that you see in this slide is the graph for total variable cost. The higher the number or the quantity, the higher the cost. But the unit variable cost is same. In this example, the SMS cost or the text cost is 5 cents per text. So the unit variable cost graph is like this that you see in this slide. It is a straight horizontal line. One text 5 cents, two texts. If a person send two SMS or text, the total variable cost is 10 cents, but unit variable cost is still 5 cents. Unit 5 cost means total variable cost divided by quantity. Okay, the thing that we used earlier. You have a business. Our example is you have a business. You have a soft drink business. A bottle of soft drink. The direct material cost is $1.50. So direct material cost is a variable cost. So one bottle $1.50. Two bottles, the total variable cost is $3 because two bottles times $1.50 equal to $3. That is total variable cost. But unit variable cost is same. If you produce two bottles, the variable cost per unit is still same, $1.50 per bottle direct material. $3 is let's say you produce 3 bottles. 3 bottles, the total variable cost is 3 times $1.50. So the total variable cost is $4.50. But unit variable cost is still $1.50. Why unit variable cost is still $1.50? Total variable cost is $4.50 for 3 bottles. So unit variable cost or variable cost per unit is equal to $4.50 divided by 3. So the unit variable cost is same, $1.50. So if you plot the graph for unit variable cost will look like this one. Will look like the one that you can see in this slide. Okay, this is variable cost per unit. You will use this knowledge in the later chapter. It is very important. Okay, and then what is a fixed cost? So fixed cost is a cost that will not change. Even though the quantity of production or activity of production is changing. Okay, in this day-to-day example, the slide says that your monthly contract fee for your cell phone is fixed. For the number of monthly minutes in your contract, the monthly contract fee does not change based on the number of calls you make. So you have your handphone, so there are fixed costs, amount that you have to pay every month. No matter how many minutes you use the phone or use the internet, you pay the same amount. That one is called fixed cost. Okay, so but in a business, if you have a manufacturing business, most of the time you have several fixed costs. The typical example is the rental. Let's say you have you produce soft drinks. You have a business that produces soft drink. You rent the factory building. So every month you pay $10,000 for rental. That rental is an example of fixed cost. Why? Because no matter how many bottles soft drink you produce, you you have to pay the same amount of rental every month, $10,000. You produce one bottle, still you have to pay 10,000. You produce 20,000 bottle soft drinks, still you have to pay $10,000 per month for the rental. So that rental is an example of a fixed cost. Another example is depreciation. Remember, you have learned in financial accounting, if you have a business and then you have fixed asset like machines or equipments or building or etc. So every year you have to calculate depreciation. Depreciation is an example of fixed cost. No matter how many units you produce, you have to record the same amount of depreciation. And there are several more examples. Okay, so in this slide you can see the graph for total fixed cost. So you can see the graph is like a straight horizontal line. It shows that the cost is same. Like the cost for the rental, the example is $10,000 rental per month. So the cost is same, no matter how many units of product you produce, same. So the cost is fixed. So this is the graph for total fixed cost. But if you draw a graph for unit fixed cost, then you will get a graph like this. You will get a line like this. You see in this, the purple line in this slide. So that is the line for unit fixed cost. So unit fixed cost, the formula to calculate the unit fixed cost is total fixed cost divided by quantity of production. So let's say your total fixed cost is $10,000 per month. When you produce one bottle, the unit fixed cost is $10,000 divided by 1, so equal to $10,000. But if you produce 2 units, now the unit fixed cost is $10,000 divided by 2. The answer is $5,000. So you can see the line drop very fast. And then if you produce 10 bottles, so 10,000 divided by 10, the answer is 1,000. So it dropped very fast. The unit fixed cost drops very fast. But another one is the more the business produce products, the lower the unit fixed cost. The more a business produces its product, the lower the unit fixed cost. But the unit fixed cost will not reach 0. You can use the calculation. You will see that the more a business, if the business, in our example, if the business produces one product, then unit fixed cost is $10,000. 2 products, the unit fixed cost will become $5,000. 10 products, the unit fixed cost become $1,000. How about 100 products? If the business produces 100 product, then the unit fixed cost is 100. But if the business produces 10,000 product, then the unit fixed cost will become $1. So the more the business produces its product, the lower the unit fixed cost. You will use this knowledge later in in a chapter where you will learn about cost volume profit. Also, if you learn more about accounting, you will know that your knowledge about fixed cost and variable cost can help you to do cost prediction. Maybe we will see that in the future topics. Okay, this is the summary of behavior of cost within the relevant range. I don't want to explain about relevant range, but I will. The thing that I can say is, in short term, cost can be categorized into variable cost and fixed cost. But in long term, all costs are variable costs. Okay, that is the thing that I want to say. But enough for you to, if you can understand this table here. Variable cost. Okay, let's see the summary here. For variable cost, in total, the total variable cost changes as activity or quantity of production changes. But per unit variable cost remain the same over wide ranges of activity. Okay, total fixed cost remains the same even when the activity level or quantity of production changes. And then per unit fixed cost, average fixed cost or per unit fixed cost goes down as activity or quantity of production goes up. Okay, this is important thing. You have learned about several categories of cost. So then the thing is this thing is very important. If I give you a list of 10 items, you have to know which one is fixed cost, which one is variable cost, which one is direct material, which one is direct labor, which one is overhead, which one is prime cost, which one is conversion cost, which one is product cost, which one is period cost, etc. So very important. So in this sample question, so let's see the question asks about what? Which of the following costs will be variable with respect to the number of cones sold at Baskin and Robbins shop? There may be more than one correct answer. So you know Baskins and Robbins shop, it is an ice cream shop. So the question asks you which one is or are variable cost. Okay, let's see. A. Before you can answer this question, you have to remember the definition of a variable cost. So a variable cost is a cost that will change when the quantity of production changes. So let's see. A. The cost of lighting the store. What do you think? I think it is a fixed cost. Because no matter how many ice creams the shop sells, the cost of electricity to lighting the shop is same. If the business has 6 LCD lights, for example, the cost is same. If the business sell 1 ice cream or 2 ice cream or 3 ice cream, the lights that the business use are same. Okay, so I think A is the fixed cost. B, the wages of the store manager. The wages of store manager, I think, is also a fixed cost. Because no matter how many ice creams the business can sell, the store manager salary is same. Every month you have to pay him or her maybe $5,000, $6,000. See, the cost of ice cream. What do you think? I think the cost of ice cream is a variable cost. Because if you sell, let's say the cost is $2. If you sell 1 ice cream, then $2. If you sell 2 ice creams, the cost $4. You sell 10 ice creams, then the cost is $20. So I think C is a variable cost. D, the cost of napkins for customers. This one also I think a variable cost, because the more customers, the more you have to pay for the napkin cost. So let's see. See here, the answer is C and D are the variable cost. A and B are fixed cost. Okay, this one is another one. Another category of cost. Cost also can be categorized into direct cost and indirect cost. So you can see the definition here. Okay, let's see the gray box first. Direct cost. Direct costs are costs that can be easily and conveniently traced to a product or other cost object. The examples are direct material and direct labor. Very, very easy. If somebody says direct cost, so you have to know direct cost are costs that can be traced directly to a product. In a simple way, we can say that direct costs are the costs that we can see when we see a product. So when you see a product, let's say of soft drink, a bottle of soft drink. So what are the costs that you can see directly? The first thing is you can see direct material. You can see the bottle, you can see the drinks, you can see the label. So all these are direct material costs. Another one that you can trace or see directly is the direct labor cost. Why you can see or trace directly the direct labor cost? Because if you go to the factory and you observe the activities in the factory, you can calculate how many labor hours is used to produce the soft drink. If you know the labor hours, total labor hours used to produce the soft drink, then you can calculate how much is the direct labor cost for a unit of product. So that is why direct labor also is a direct cost. So if there is a question asks you, what are the direct costs? The answer is very simple. You have to memorize this. Direct cost equal to direct material cost and also direct labor cost. Okay, indirect costs are costs that cannot be easily and conveniently traced to a unit of product or other cost object. For example, the manufacturing overhead. So, indirect costs are costs that cannot, that has no direct relationship with a product. This cost is like this. Let's say you have a factory. You have a factory that produces soft drinks. You have 3 flavor of soft drinks. Oranges, cola, and grapes, for example. So, direct costs are direct material and direct labor. You can see for each soft drink, this is the direct material, this is the direct labor cost for every or each soft drink. But in your factory, you have janitors. Janitors, he clean the factory every day. So you have 10 janitors. Every month you pay $15,000 salary for 10 janitors. So the salary of these janitors is an example of indirect cost, because you cannot trace directly. These janitors works in the factory, and that factory produces 3 soft drinks. The $15 you have paid to these janitors cannot be traced directly to your product. When you see your soft drink, you cannot see the direct link between the $15,000 salary and the product. That is an example of indirect cost. The depreciation of the building, also an example of indirect cost. If you have factory supervisors in your factory, you will have factory supervisors. Factory supervisor salary is also an example of indirect cost. Security guards salary also is an example of indirect cost. So most of the time, manufacturing overhead costs are indirect costs. Okay, and actually there is another category of cost. This category of cost or classification of cost is useful when you want to make business decision. The the categories are opportunity cost, differential cost, and sunk cost. But in this cost, this category of cost are not included in the syllabus, so don't have to worry about this. Okay, this the summary of type of cost classification. Okay, you have learned about categories or type of cost: manufacturing cost, non-manufacturing cost, product cost, period cost, direct cost, indirect cost, prime cost, conversion cost, etc. So this knowledge is useful when you want to do financial reporting. Financial reporting is the time where you prepare the financial statement. Your knowledge about the cost categories is important and useful when you prepare the financial statement. Another thing is your knowledge about the cost categories is also useful when you want to predict cost behavior. If you have a business, you want to predict next month how much cost you think you have to pay. Next year maybe you want to know in roughly how much cost you have to pay next year. So your knowledge that you have learned in this topic about cost category will help you to do the cost prediction. And also when you know the cost categories and classification, this knowledge help you to assign cost to cost objects. Later you will learn about cost assignment, how to divide cost to products that a business produces. So you will learn that later. And also your knowledge about categories of costs can help you to make business decision. This one is also you will learn in later chapters or later topics. Okay, this is the last thing that you have to learn in this topic. This one is not this is not new. This is balance sheet for a manufacturing business and for a merchandising business. You know this before. If you look at a balance sheet for a merchandising business, the business will have only one type of inventories. Maybe the inventories are called merchandise inventories. But if you look at manufacturing business balance sheet, you will see that the business has three types of inventories: finished goods inventories, work in process inventories, and raw material inventories. I have explained this in previous lecture. Okay. Okay, this is the income statement for a manufacturing business. Remember I told you when you learn about management accounting, the focus is mostly on manufacturing business because you will learn about costing. You will learn about how to calculate cost for a product produced by a manufacturing business. So this is the income statement for a manufacturing business. So when you prepare income statement for a manufacturing business, the format is like this. So the first thing is you have to show the sales or revenue. See in this example, the sales is $366,000. And then remember, after you show the sales, you have to minus the cost of goods sold. The calculation or format for the cost of goods sold is like this. You have to show the finished goods inventory, and then you have to add cost of goods manufactured. Okay, memorize this first, and then after that, you will get a number. Finished goods inventory at the beginning of the year plus cost of goods manufactured, you will get a number. And then you have to minus or less finished goods inventory at the end of the year. In this example, the amount is 62,500. So you will get the cost of goods sold. In this example, 287,500. And then see here, the first item is sales minus the cost of goods sold of $287. $287,500. You will get gross profit. Gross profit equal to 78,500. After you have calculated the gross profit, you have to minus the expenses. The first expense is selling expense. The second one is the admin expense. Total expenses equal to 35,000. So 78,500 minus expenses 35,000 equal to net income or profit 43,500. This is the income statement for a manufacturing business. You have learned about all these items before, except one thing. See the third item in this income statement, the cost of goods manufactured. This is unique to a manufacturing business because a manufacturing business produces something. Remember, a manufacturing business is a business that produces something. So when a business produces something, it has to pay cost. That cost is called manufacturing cost. So that cost you calculated using cost of goods manufactured schedule. Okay, so before you can prepare this income statement, you have to calculate the cost of goods manufactured first. So let's see here how to calculate the cost of goods manufactured. Okay, this is a sample question that shows you how to calculate cost of goods manufactured. Okay, this is the example. Let's say there is a business, top 1 manufacturing company, and that business has this data: work in process inventory at the beginning of the year, at the beginning of the month, and work in process inventory at the end of the month, finished goods inventory at the beginning of the month, finished goods inventory at the end of the month, direct material use, indirect material use, direct manufacturing labor, indirect manufacturing labor, property tax and manufacturing plant building, salesperson traveling expenses, depreciations of manufacturing equipment, depreciation of office equipment, plants, utilities, miscellaneous plant overhead, general office expenses, marketing and distribution costs. So the question asks you, prepare a cost of goods manufactured schedule for the month of January. So I told you before, when you prepare the when you have to prepare income statement for a manufacturing business, the format is like the format that you have seen in the previous slide. And in that format, you can see that you have to calculate cost of goods manufactured. So to calculate the cost of goods manufactured, you have to prepare a schedule. It is called a cost of goods manufactured schedule. So if these are the data, then the schedule is like this. See here, the schedule, very simple. The format for the cost of goods manufactured schedule is very simple. First, you see the first item in the top half of this slide. The first item is you have to show the direct material use. In this example, the direct material use is 378,000. And then second item, you have to show the direct manufacturing labor cost. In this example, it is 480,000. After that, you have to list all the manufacturing overhead costs. You check, you see the question in the previous slide. You have to identify which which costs are manufacturing overhead costs. So you have to identify the manufacturing overhead costs, and then you have to list all the costs here. See here in this example, there are 1, 2, 3, 4, 5, 6 costs, and you calculate the total cost. The total manufacturing overhead cost equal to 7,902,100. So you add these three costs, the direct material cost, direct labor cost, and overhead cost. You will get a total. The name of the cost is manufacturing cost incurred. The total is 1,648,200. 1,648,200. That is the manufacturing cost incurred. After that, you add beginning WIP inventory, and then you minus the WIP ending inventory. The final amount is the cost of goods manufactured. So when a question asks you to prepare an income statement for a manufacturing business, so the step is like this. You prepare this schedule first. After you have prepared the schedule, you get the number, and then you can prepare the income statement for a manufacturing business. I think I have prepared a video for this preparation of cost of goods manufactured. I will share with you the video later. So this is the end of lecture for this week. Do not forget to write your name and metric number in the comment section, because that is your attendance for this lecture. Thank you very much.